and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Good morning, everyone. I'm Mark Rosenthal. Here's what's happening on this Tuesday. The heat is on big time. It's hazy, hot, and buggy weather. Temperatures in the mid-90s. There could be a late-day shower or thunderstorm. Overnight, mainly clear, warm, and buggy. Temperatures by morning 68 to 74. And tomorrow, sun clouds, hot and buggy. Temperatures could jump over 90. Watch for late-day showers and storms. Thursday, lots of sunshine, much cooler and drier weather. Forecast being brought to you by Needham Coin and Jewelry Buyers, located at 317 Chestnut Street in Needham. They're the most highly recommended place to sell your coins, jewelry, gold, silver, and historical items. Call 774-766-3050. That's my forecast. I'm Mark Rosenthal.
My name is Dale Pazinski. I volunteer with United Way to help the homeless in my community learn computer skills and build a basic resume. I don't just wear the shirt, I live it.
Give, advocate, volunteer, Live United. Go to liveunited.org. Brought to you by United Way and the Ad Council.
This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM. Concord, Boston, the Money Matters Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative James McGovern are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
As a busy mom, my to-do list is full.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has information to help you and your family live a healthier life.
Visit goredforwomen.org/momlife today.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One of the biggest challenges in financial planning is seeing the full picture. When your investments are spread across multiple accounts, it can be difficult to know how much you actually have and whether your strategy is really working. You might be taking on more risk than you realize or missing opportunities to better align your portfolio. Bringing your accounts together can help create clarity so you can see your total assets, your true allocation, and make more informed decisions about your financial future. Our new guide is called Consolidating Investment Accounts. It walks you through how to get organized, simplify your strategy, and build a more complete financial plan. Call 800-393-4001 to get your free copy today. That's 800-393-4001, or you can request the guide by visiting armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
For many hardworking families and retirees, an energy bill comes with an impossible choice. Paying the bills, putting food on your table, and keeping your family warm in winter and your home cool for the summer. But it shouldn't be that way. For more than 40 years, Citizens Energy has made one simple promise: to help households afford life's basic needs. Through Joe for Oil, we help neighbors through the coldest winter nights. Now, we're building on that same promise with Joe for Sun, a new way to save on electricity year-round. Our solar projects are already in communities across Massachusetts and New York, helping thousands of households save money. For many families, that means saving up to 50% on electricity. No installation, no equipment, and you keep your utility company. Like my dad's program before, we keep it simple, helping lower your utility bill through community solar at no cost to you. Call 1-855-JOE-FOR-SUN or visit citizensenergy.com to see if you qualify. You've trusted Citizens Energy to show up when it matters most. We're still here, ready to help.
Sponsored by Citizens Energy.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke with your Financial Exchange Quick Tip of the Day. And today, we're talking about the top estate planning mistakes to avoid. Todd, a lot of people create their estate plan, but there are some that don't actually transfer assets into it. Can you explain why this is such a big mistake?
Sure. I mean, I'm going to try to explain it both from a revocable and an irrevocable planning standpoint. With the revocable, if you don't put assets in there, you end up leaving them owned perhaps jointly if you're married, and designated beneficiaries and the like. But if everything goes to the spouse, when one dies, then you've completely avoided your estate plan. In other words, you've set your trust up, but you went around it by leaving everything to the spouse instead of going through it by funding the trust and cramming down the assets to shelter some from estate taxes on the first death, so there's less taxed on the second death. And ultimately, on the second death, if you don't plan, there could be a probate problem because everything would go to probate if it's in their own name. The other big reason is with an irrevocable trust, of course, not funding it also can result in estate tax problems by the same way it did with the revocable trust. But in addition to not funding them with the irrevocable, you don't even begin the 5-year waiting period to get the assets protected from the nursing home. So there's a much bigger problem not funding an irrevocable trust versus not funding a revocable trust. So make sure you fund your trust if you do your planning.
Well, luckily, Todd Lutzke and the estate planning experts at Cushing & Dolan have written a brand new guide that details the estate planning blunders to avoid. You can request this brand new guide by simply calling 866-848-5699, 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts. Do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Good morning and welcome back to the Financial Exchange. It's Mike, Paul, and Tucker with you on a relatively busy earnings week, not only for the AI trade with NVIDIA going tomorrow after the bell, but retail earnings all over the place. This week we are hearing from Walmart being the biggest one, but Home Depot this morning, Lowe's, Target, TJX, and I'm sure a few others that I'm forgetting of. Deere's in there, but not exactly a retailer. And markets haven't really been sure what to do ahead of those earnings, mainly the earnings coming from NVIDIA. We remain under strain from an inflation and interest rate perspective due to the events in Iran. The 10-year Treasury now sitting about 4 2/3%. Price of oil dropping a little bit today, but still in the over the $100 mark, about $108 per barrel here. And we're left with digesting earnings from a traditionally big retailer, certainly a large company, but a good indicator for the state of the housing sector, which is Home Depot. And I think, in my opinion at least, Paul, relatively unsurprisingly here, neither fantastic nor devastating news from Home Depot, given the state of things in the housing market.
No, it continues to be the same refrain from Home Depot, Mike. The last couple earnings calls, they've had the same sort of sentiment, which basically is that consumers are deferring spending on larger projects. There really has been, since interest rates have rose on mortgages, which goes back now 3 or 4 years, maybe even a little bit more than that, 22, they started to pick up, that people are not willing to borrow, whether it be through a home equity line of credit or just in general to do the big kitchen renovations or to do the big add-ons to their properties. And so as a result, Home Depot has had trouble making up the tremendous sales growth that they saw during that post-COVID period. In terms of the numbers that we saw from this earnings quarter, yeah, they beat a little bit on top line for revenue forecasts, but those had been adjusted down. The bar had sort of been lowered for those numbers previously, so it wasn't as if this was some tremendous beat. In terms of their comparable sales growth, which this is the metric that is focused on the most of their existing stores, how much did they see in terms of sales growth year over year? That number came in at 0.6% year over year, which was less than what analysts had anticipated of about 0.8%. So kind of missed on the sales growth number. They continue, Home Depot, to really focus, Mike, much more on the pros side of things. So they are less focused, not to say that they're unwilling to sell to me and you, the regular Joe Schmo going in there on a Saturday, but really,
because they know that we have no idea what we're doing. We're going to buy 5 different versions of the same thing.
They can make a big ticket there, but not as big nearly as a professional contractor can be. They've made 3 strategic acquisitions in that space over the course of the last few years to really sort of get a further inroads into roofing and landscaping and pool professionals and products distributors. That has really been the strategic focus of Home Depot, as the regular consumer has been sort of weak and a housing market that's been really tepid. They're spending more money investing in the pro contractor.
Yeah. So, look, I think as Paul laid out, I mean, there's some clear reasons why they are not immensely succeeding, and I think most of that has to do with the state of the housing market. And, speaking of which, we've gotten plenty of data over the last couple of weeks here, but a big point that matters would be existing home sales, right? I mean, for Home Depot, if you think through the amount of spending that goes into a home when it is getting prepared for a sale, landscaping, painting, minor projects, and then after a sale, in terms of, improvements there's a lot of contractor expense going into it. And right now, in April of this year, we had almost the exact number of home sales that we did in April of last year. No growth. 4.02 million home sales in the month of April, and you saw literally no growth, a 0% growth rate from April of last year. Taking a look at other factors in here, the inventory situation in the country has been improving, but not quickly enough to really benefit, I think, the overall housing market. There are currently, as of April of 2026, this is according to Realtor.com, who tracks active listing counts. This includes condos, single families, etc. It's just over 1 million units for sale, which is a vast improvement compared to April of 2022, when there were under 400,000 units for sale. But in April of 2019, there were about 1.14 million units for sale, and so we have not really improved upon that factor. One little piece that is interesting to me, we did see in the month of March housing starts bump up a little bit to 1.5 million. That is at an elevated rate compared to pre-pandemic levels, and I think builders are hoping to build but still struggling with the interest rate environment. Yep. And so the real question when it comes to the likes of Home Depot, in my mind, and the housing market generally, would be, are we overestimating what needs to happen with interest rates? Right? Because right now, when you take a look at futures markets, it's estimating that rates need to go up in 2027. That is the next move, is a move upwards. Clearly, the next Fed chair has called that into question a little bit, but ultimately, we are already sitting at, let me take a look, as of yesterday on the 30-year fixed-rate mortgage, 6.68%.
Yeah, I was just looking at that. Yeah, we're creeping back up to that 7% threshold.
Really extremely difficult for me. I mean, one, we're already too late into the spring housing market. Even if that were to drop tomorrow, it's not going to drop substantially. Best case scenario in my mind, if the Strait of Hormuz miraculously reopened, maybe you're getting into the high 5s. And, the spring housing market is nearly over. We're already towards that June time frame, and just not a lot of homes sell in the summer market for a number of reasons. You could get a boost to the fall market, but the fall market is almost always smaller and less volume. And like I just said, most bets that are out there are being wagered on rates going higher, not lower. So my sense would be really tough to envision the spring housing market, signifying anything significant in the overall housing sector. Your results may vary. Obviously, this is very regional. In Connecticut, if you list your home You'll probably have a line out the door and plenty of offers. If you're in Florida, very different situation. I sound like I smoked a pack of cigarettes before I started the show today. I'm not sure why. But overall, what matters for the state of the housing market and for companies like Home Depot is there's a receptive market towards construction? Is it a market where a lot of builders want to get out there and put up a lot of new homes? And the answer, for a number of different reasons right now, is not really. Commodity prices on the rise, interest rates, which a lot of people bet were coming down this year, have reversed. And if you are Pulte making your plans for the rest of this year, I can't imagine you're getting super excited about trying to hire a bunch of people away from building up data centers to go and spend a bunch of money building new homes in a development where you're just unsure of what the market's going to look like.
Do you feel that you had kind of posed the hypothetical that we are overestimating the impact of interest rates on the housing market? I don't think we are necessarily. I mean, I'm just looking at the U.S. 10-year Treasury, which is the benchmark for the 30-year fixed mortgage that Mike was speaking about before. Prior to the war beginning, we were sitting about 4%, 3.96 on February 27th, the U.S. 10-year Treasury. We now sit at 4.65. That's a meaningful impact, almost a one-for-one, in terms of the basis point impact on mortgages. But just curious, your thoughts. I think it is pretty sensitive that if we were creeping back down to the fives, that I would be a little bit more optimistic on the housing market.
Yeah, I mean, look, there's a few pieces of this. One is just the pure affordability conversation.
Mm-hmm.
You can afford less dollars of house when you have a mortgage rate at 6.7 compared to 5.9. There's also a psychological effect there. And I do think that there are buyers who simply say, I'm waiting until I can buy into a market with a mortgage rate with a 5 in front of it instead of with a 6 in front of it. Mm-hmm. And that just does remove some buyers as well as some sellers who say, I'll just wait for a market where oil prices aren't shooting up, where people are worried about the state of war in Iran and higher interest rates. I'm just going to hold off. So, yeah, I do think there's a meaningful impact. Very tough to measure, but we see it in listings. We see it in sales. And I think a lot of that, most of that, does have to do probably with interest rates. Let's take a quick break. When we come back, piece from the Wall Street Journal about everything feeling more expensive these days. Clearly, we're seeing it in the housing market and mortgage rates, but I want to talk about that phenomenon a little bit and how people are self-identifying themselves in terms of where they fall in the class system of U.S. economics. That's next on the Financial Exchange.
The Financial Exchange streams every day live on YouTube. Subscribe to our page and follow the markets all morning long. Only here on the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One of the biggest challenges in financial planning is seeing the full picture. When your investments are spread across multiple accounts, it can be difficult to know how much you actually have and whether your strategy is really working. You might be taking on more risk than you realize or missing opportunities to better align your portfolio. Bringing your accounts together can help create clarity so you can see your total assets, your true allocation, and make more informed decisions about your financial future. Our new guide is called Consolidating Investment Accounts. It walks you through how to get organized, simplify your strategy, and build a more complete financial plan. Call 800-393-4001 to get your free copy today. That's 800-393-4001, or you can request the guide by visiting armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Long-term care costs can reach thousands of dollars per month and can put a serious strain on your savings. The experts at Cushing & Dolan often see families caught off guard by that reality. Without the right plan in place, those costs can quickly eat through a lifetime of your hard work. But here's the shocker. Many estate plans don't protect your assets from those expenses. The right strategy may involve specific types of trusts designed to help protect your assets, but timing matters. Cushing & Dolan has a brand new guide called Detour Ahead, Estate Planning Potholes to Avoid. It breaks down some of the most common and costly mistakes people make and explains how to help protect your assets, your family, and your future. Call 866-848-5699 to get your free copy today. That's 866-848-5699. Or you can request the guide online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
I was 24 when I had a stroke.
I was 35 when I suffered a heart attack.
I was 46.
I was 62.
It's a fact. Cardiovascular disease is the leading cause of death in women.
But we can fight against our #1 killer.
Talk to your doctor about your risk factors.
Know your family history.
Learn the warning signs and symptoms.
Together,
let's go red for women.
Visit goredforwomen.org to learn more.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Our Senators Edward Markey and Elizabeth Warren and Representative Stephen Lynch are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Like us on YouTube and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
The Financial Exchange streams live every day on YouTube. Subscribe to our page and follow market activity all morning long. Only here on the Financial Exchange Radio Network. Just search the Financial Exchange on YouTube and be sure to hit that subscribe button.
So, very clearly, if there's one theme in the U.S. economy over the last 5 years, it's affordability. I think it's arguably why Democrats lost the last election.
Yep.
I think that it is having a ton to do with people's outlook on the economy today. And it is a key focus for just about everybody, especially now with gas prices moving up. I'm also comfortable saying that the New York Times profiling a family of 3 who's earning $500,000 and bemoans their income situation and describes themselves as firmly middle class is out of touch. So don't get me wrong. Manhattan, one of the most expensive places, probably the most expensive place in the country to live, especially if you're living on the Upper West Side. But I looked it up, and in the New York metro area, if you are earning $500,000, that puts you in the top 5 to 7% of people of households in that area.
Mm-hmm.
So there is no definition of middle that, you being in the top 5 to 7% of people, aptly describes. And, if you are feeling like your $4,200 a month daycare bill and your $3,900 a month rent,
which by the way, that feels very low for Manhattan
for a family of 3 living in Manhattan
for
on the Upper West Side.
$3,900 a month.
Yeah. I understand why people are frustrated with affordability, scarcity, the cost of labor, childcare especially. Experience that firsthand. When my kids graduated daycare in Massachusetts, it's tough. It's genuinely tough to send more than 2 children to daycare on a salary of less than $100,000. So that's a firm reality there that I fully acknowledge. But I'm also comfortable saying that if you're earning $500,000 in the New York metro area, you're not middle class.
Well, the cherry on top was that they were saving $10,000 a month, which is just like unbelievably
An obscene amount
fantastic.
of
I mean,
money.
you and I do this for a living where we meet with people every day, and
If you
that's an
don't feel like-
incredible savings rate to be able to have. But let's call a spade a spade. They knew what they were doing here, Mike. Like, I mean, this is to get you fired up about it. It is a broader point of this 500,000 example is outlandish to get people to click on it and talk about it, and for everyone to get upset by saying that anyone suggesting that they're making $500,000 and is feeling middle class is off base. But
Move to Harlem.
But
you don't need to live on the Upper West Side and feel poor. Give me a break.
From a broader perspective, the reason I like this Wall Street Journal piece that's in response to the New York Times piece is this idea of hitting on some areas of why, forget this couple with the 500,000. Why do people feel leaner? And I think this point does hit home.
Sure.
For like, I have a family member who they're about to have their third child, and they both work. And this is one of the pieces that's hit on here in this Wall Street Journal piece. Back in 1975, you had 45% of married mothers actually active in the workforce. That number sits at 72% today. So far more houses that are dual income earning. But for this example that I'm talking about locally in the greater Boston area, my wife and I were just chatting about the cost it would be for those 3 kids to be in some sort of daycare or have some sort of babysitter. And you know this stuff too. It's a huge number where basically, to your point, $100,000 salary will probably cover the cost of their care, but that means somebody else has to have a salary. And I think that point is absolutely salient and is a real issue. And it speaks to this broader point in general regarding the swelling of costs, where healthcare, childcare, and education are 3 areas over the course of the last, however you want to do it, 25, 30 years, that don't have nowhere near the productivity gains that we have in basically having a computer on my, on our desk here, in my iPhone, and the other technological advancements that you've seen in cars and other areas. That's the point.
It's pretty indisputable that Americans, on average, have gotten wealthier and have a increased quality of life over the last 50 years. You can measure it. They do a good job pointing out the car in your driveway, far less likely to kill you. Traffic fatalities per mile driven have fallen 62% over the last 50 years. Life expectancy, an extra 3.6 more years for somebody reaching the age of 65. The air we breathe is cleaner. Like, lots of quality of life things have changed. To your point, a television that I can slap on the wall is a fraction of the cost. The cell phone in my pocket is, unrecognizable, certainly to somebody in the 1970s, but even unrecognizable to somebody in the 1990s.
And even like 2008, I was looking at some Celtics thing the other day for a parade back 17 years ago. The flip phone cameras, how far we've come from that, it's wild.
So technological innovation and prices moving down for really high-tech items has arguably improved our lives in ways that are difficult to measure. But to the other side of that equation, things that are not technology-driven, things that cannot be outsourced to China like the manufacturing of televisions can, are absurdly expensive in some parts of the country. And American families, especially those with young children or older adults, we bemoan all the time, Paul, the talk of childcare, because Massachusetts is the most expensive state to pay for daycare in the entire country. So is sending somebody to a nursing home. You think about the other side of that equation here. Anything that requires hands-on care is absurdly expensive in much of the country, and there isn't really a path that I'm seeing to improve upon that. I think clearly robotics is being discussed as a way of the future. We're not there anytime soon. In the meantime, a large demographic for people who provide the type of care that we're describing, either end-of-life care or child care or construction costs, all of these things that have gotten, right? Does anybody look at housing construction and say, wow, that's so affordable? These are all, oftentimes done by migrants or an uneducated class that, has come to the United States historically to do that type of work. And we're making some policy decisions right now that the majority of Americans polled seem to agree upon, that we don't want to allow that type of migration. And so it's difficult for me to envision a scenario where, for the family starting, out over the next decade, how do I see a scenario where childcare becomes more affordable? it'd have to be subsidized.
Mm-hmm.
How do I see a scenario where end-of-life care, nursing homes, and assisted living facilities become more affordable? Same story. Yeah, that's the only real path to it, which doesn't mean that it's getting more affordable. It just means that it's being borne by the taxpayer rather than the individual covering the care, because there's only really one direction for that type of attentive needs and skill to go, which is wages have to go up over the course of the next decade. Let's take a quick break. When we come back, full market update here. We got a bit of a sell-off in early trading. That's next on Wall Street Watch.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network. Some of the biggest estate planning mistakes are the ones you don't even know you're making. At Cushing & Dolan, they've seen it all. Plans that aren't complete, that only rely on a will or lack of funding of a trust. These are the kind of mistakes that can lead to probate, unnecessary taxes, or even putting your assets at risk. As your life changes, so should your estate plan. Marriage, grandkids, new assets, and even changes in tax law can impact how your plan should be structured. That's why Cushing & Dolan created a brand new guide called Detour Ahead, Estate Planning Potholes to Avoid. It walks you through the most common and costly mistakes and how to help protect your assets, your family, and your future. Call 866-848-5699 to get your free copy today. That's 866-848-5699. Or you can request the guide online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
In Massachusetts, summer starts at the farmers market. Longer days, fuller tables, and the best local food coming in fresh each week. Find just packed produce, responsibly raised meats, small batch cheeses, fresh caught seafood, and thoughtfully made goods. It's where neighborhoods come together and local food shines. Stop by your market this season and support farmers and makers across the state. Sponsored by Mass Farmers Markets. Growing farmers markets across Massachusetts. Find your local market at massfarmersmarkets.org.
In a heartbeat, you could be the difference.
Mark collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we have a guide available this month titled Consolidating Investment Accounts. Mike, how does someone end up with just this sprawl of different accounts over time?
We've all seen it before with family members or even ourselves, but according to the BLS these days, the average person stays at a job fewer than 4 years. And so imagine you're job hopping from place to place. You might have a retirement plan through there. And all of a sudden, a decade into your career, you could have 2 or 3 different retirement plans just from, changing jobs and taking that next promotion at a new place.
It doesn't even just happen with different retirement or investment accounts. It can happen with bank accounts or insurance policies. You can end up with stuff scattered everywhere.
Well, we all know that, that aunt or that family family member that is always scouring for the best CD rate or interest rate on the savings account, or, has some money with this broker and this financial services company. And all of a sudden, you can be looking at a situation where over the years, you have a dozen different places where you keep assets, and that becomes more and more complicated to ensure that your spouse is on there, that you have beneficiaries aligned properly, and that you can actually monitor these things.
Folks, our guide is titled Consolidating Investment Accounts, and there are 2 ways that you can request it. The first is by calling 800-393-4001. The second is by going to armstrongadvisory.com. That phone number again is 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Seeing a little sell-off on Wall Street at the moment as investors react to the first big retailer earnings from Home Depot this morning. As for the Middle East, President Trump announced late yesterday he was calling off a plan to attack Iran after Gulf states appealed, wanting more time to pursue diplomacy. Right now, the Dow is down about 0.33%, S&P 500 down 0.8%, NASDAQ selling off 1.25% or 331 points. Russell 2000 is down nearly 2%. 10-year Treasury yield is up 5 basis points at 4.67%, and oil down 0.2%, trading right around $108 a barrel. Home Depot stock is up about 0.5% after the home improvement retailer beat street expectations and reaffirmed its full-year guidance. The company said its core consumer remains engaged despite higher gas prices and waning consumer confidence. Lowe's, TJX, and Target are on deck tomorrow and will report earnings ahead of the opening bell. Meanwhile, the Wall Street Journal reported that Alphabet's Google and Blackstone plan to create an AI cloud company to compete with the likes of CoreWeave using Google's specialized chips. Alphabet down by 2%, Blackstone stock is off nearly 1%, and CoreWeave shares are down over 7%. And ServiceNow stock is up by 3% after Bank of America analysts said the business software company would benefit from AI, giving the stock a buy rating. I'm Tucker Silva, and that is Wall Street Watch.
Paul, there's been increasing pushback to data centers, I guess just the general topic of AI. When I speak about it with the general public, I think there is certainly a lot of excitement, but a fair bit of concern when I'm speaking with older Americans, some relief that they're not needing to learn about it and train themselves on it. But increasingly, we are getting what is, the same phenomenon that we've been dealing with when it comes to housing and other projects for over a decade now, which is the NIMBYism of, this project and the problems with it. And increasingly, I can understand why. There's a piece from the Boston Globe about the data center in Lowell and the complaints that they have there regarding noise and their concerns about air quality and all sorts of different things. Apparently, they have a diesel generator that turns on for the fans and things like that when needed. And so, the local piece of that I can fully comprehend. What I honestly feel like is that the AI industry as a whole is just doing a terrible job of representing themselves to the public, and I feel like they could use a good boost from that guy from Thank You for Smoking. I don't remember the character's name. I don't know if you guys ever saw that 2005 movie, but plenty of industries that are terrible for the environment and arguably bad for society have a pretty good and easy way of going out to the public and selling themselves as something that is in the interest of the public. And honestly, you could make a pretty easy argument with these data centers, right? I think about all of the costs that go into building this stuff, and the idea of subsidizing property taxes or utility costs or whatever method you wanted to go with as just part of the overall construction package just do not seem that challenging to me, and I don't really understand why they're not pushing forward with it, because the longer it goes on with pushback on construction and local zoning changing the rules on you, the more difficult it's going to make it in the future.
Yeah, I mean, one argument could be made that they are typically the people constructing these data centers, companies with big pockets, but my counter argument for those people with big pockets, they're probably trying to do this as affordable as possible, because there's a huge amount of CapEx that goes into building out
and
these data centers, and there's competition. So while it's easy for us to sit here in our armchairs and say they should just subsidize more of the costs for the town, whether it be through property taxes or other subsidies that these hyperscalers could push forward, they're worried about their shareholder return and the bottom line. So there is that.
You know what the other piece of it is, too? It is not unlike, it does remind me a lot of the HQ2 discussion that we had with Amazon, where it's not the same thing. Amazon HQ2 was going to employ, thousands of people, but what Amazon was able to do was, go out there to city after city and say, hey, come to us with your best proposal, all the tax breaks you can get. And honestly, that's probably what these data centers are able to do now, too, with a little bit less fanfare.
I think they started that way, but then once they consumers realized the potential ripple effects of utility costs and things like that, I do believe early on that they did have the leverage in their court to be able to say, we're going to come in, we'll pay you a ton of money to put this facility here. But now the weight has swung back into the politician side being more concerned about public outcry against it. But you mentioned a good point of what these AI leaders should be doing from a marketing standpoint. And I do feel as if they need to reshape the narrative about artificial intelligence and try and educate the public more, and also probably frame it in a more easier to grasp manner, because I feel like a lot of these people, whether you want to talk about Anthropic, OpenAI, all the big players, tend to kind of veer to this sort of dystopian view that the technology is going to become so overwhelming and so powerful that it's going to be able to do all these things that creates fear in the system. Sure. I'm going to lose my job. But the approach on my end, and they're just talking up their book, right? They're just trying to make it justify the billions of dollars that they're spending. But there should be a bit more of a measured approach to, hey, these are the productivity enhancements it can provide you, not going to that further level of, Mike, you and I are going to need to figure out how to spend our 40 hours a week because all jobs are going to be, obsolete, and we're going to be living in this just sort of social welfare state.
Even just practically speaking, this isn't likely the way it goes out, but if you're one of those companies building the data center, one, I think you could do more to, endear yourself to the local community. But just practically speaking here, if you're building this AI giant data center, you are becoming a giant customer of the local utility without a lot of complexity, right? Like, think about the size of one of these data centers and compare it to a housing development and all of the electrical infrastructure and power that needs to go to each individual property. And now just compare that to one giant data center where you're just building a road and a giant electric line to one customer that is
going to take 10 times more power than
10 times more power,
residential.
But they are going to pay for it, and it's not going to be this complex build out of, we need to feed power lines to these different. And I've heard that argument play out, like, hey, yes, we are going to consume a lot of electricity, but it's not as though it's the same type of build out an infrastructure need of a giant housing development that might consume as much electricity. Furthermore, other infrastructure is going to be impacted, right? Hey, we are going to need to improve the internet access in the general area because we need high-speed internet in order to do this. Like, there are side effects that they don't even actually need to be paying for, that they are not publicizing in any meaningful way. And I don't think those outweigh the cost of the amount of water and electricity that they're going to consume and how much they're going to drive up those prices for me. But again, if your job is to just sell the positives, which they're not seemingly doing, I think they're falling at even the blustery, bogus information that they could be putting out there. So we will see. I think more and more municipalities, though, are going to rebel against this.
That's
and
for
say,
sure.
I don't want this in my backyard.
You read all these pieces, the amount of cancellations or delays that we're seeing with data centers continues to be on the rise, and I don't think it's slowing down, which from a broader global competitions perspective is frustrating. Even though you understand some of the NIMBYism, it's probably not the best to slow down this race when you're up against China.
Yeah, if you believe it's an AI arms race and it's a winner-take-all approach between the United States and China, then yeah, tough to justify slowing it down as much as we are. The other seemingly like definite truism right now is that while AI could replace a bunch of 20-somethings, it's compared to basically having like an unlimited population of 20-year-old interns.
I liked that quote. Yeah.
Yeah, like basically
smart but need context.
Smart but have no context for what they're doing is how they described artificial intelligence. And in a lot of ways, I think that's an apt description. I just do also challenge how safe the blue-collar worker is. I mean, clearly from this iteration of artificial intelligence, I think clearly if you are a construction worker or a nurse or a care provider or a teacher, you're pretty well insulated from all of this. But I think people continue to underestimate the power of robotics that we are already starting to see improvements in. And I know that this is kind of loosely tied to AI, but does anybody think if wages keep going the direction that they're going, that we're not going to see more automation in fast food restaurants and in healthcare and in maybe not in childcare? That would be kind of freaky, but yeah, like we're covering lots of pieces about how China is implementing robotics. And I'm just unconvinced that if you are a union worker at an auto manufacturer, you're going to be somehow exempt from any automation coming from AI. Or if you are a construction worker building housing developments in Florida, like no piece of that is going to be automated over the course of the next decade. I do believe that the closer you are to doing physical work with people, the more protected your job is from artificial intelligence gains. But I don't think it's perfectly insulated, and I think that narrative might start to shift over the next few years.
Having watched some of the videos on the robotics end of them folding a shirt of laundry or trying to open a glass door of a shower, like I think the construction workers have some time because those are very simple tasks for you and I. It take a tremendous amount of complexity for a robot to. I'm not saying that it couldn't get there. But in the auto manufacturing sense on the assembly line, I get it. Like, yeah, there's been robotics there, and there will continue to be more of those. But if I think of that worker out there in the Florida sun building a residential compound of all these different apartments and the movements that need to go there,
pretty complex.
We'll see. It's complex. Yeah.
Let's take a quick break. When we come back, new plan on home construction and Congress trying to pass a law on who can buy homes, who can rent homes, etc. We'll be covering that next here on the Financial Exchange.
Remember, you can watch the show live every day on our YouTube page. We've got market updates and breaking business news all morning long, plus a full archive of all our show's content. It's all there with the click of a button at youtube.com/The Financial Exchange Show. Long-term care costs can reach thousands of dollars per month and can put a serious strain on your savings. The experts at Cushing & Dolan often see families caught off guard by that reality. Without the right plan in place, those costs can quickly eat through a lifetime of your hard work. But here's the shocker. Many estate plans don't protect your assets from those expenses. The right strategy may involve specific types of trusts designed to help protect your assets, but timing matters. Cushing & Dolan has a brand new guide called Detour Ahead, Estate Planning Potholes to Avoid. It breaks down some of the most common and costly mistakes people make and explains how to help protect your assets, your family, and your future. Call 866-848-5699 to get your free copy today. That's 866-848-5699. Or you can request the guide online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Chuck from the Armstrong Advisory Group. If your financial life feels scattered, you're not alone. Over time, it's easy to end up with accounts in different places. Old retirement plans, different banks, multiple apps. It's what we call account sprawl. When you've got your money across the spectrum, things can get missed, like overlapping investments, and bringing everything into focus allows you to spend less time tracking accounts and more time making smart decisions. Our new guide is called Consolidating Investment Accounts, and it may offer strategies that can simplify your overall financial picture. Call 800-393-4001 to get your free copy today. That's 800-393-4001, or you can request the guide at armstrongadvisory.com. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
For many families, an energy bill can mean difficult choices, wondering when or even how it will get paid. It shouldn't be that way. For more than 40 years, Citizens Energy has helped families afford life's basic needs. First, through Joe for Oil, and now through Joe for Sun. A simple way to save on electricity at no cost to you. No installation, no equipment, and you keep your utility company. We keep it simple and help you lower your utility bill. Call 1-855-JOE-FOR-SUN or visit citizensenergy.com to see if you qualify. Sponsored by Citizens Energy.
Our Senators Edward Markey and Elizabeth Warren and Representative Lori Trahan are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play The Financial Exchange. This is the Financial Exchange Radio Network.
The Financial Exchange is incredibly proud to be a partner of the Disabled American Veterans Department of Massachusetts. Nearly 400 runners have already registered for this year's DAV 5K. The event sold out in record time last year, so head to dav5k.boston for all the information about how you can participate this November or make a donation to support our great American heroes. Your gifts help fund free rides to medical appointments for veterans and the nation's first DAV-led housing initiative providing homes for single veterans and veteran families. Go to dav5k.boston and make your donation today. That's dav5k.boston.
So we haven't covered this in a little while, but you may recall prior to the breakout of war in Iran, we were talking a lot about housing affordability, and the president actually pushed for a ban on institutional investors owning single-family homes for rent. That was a big push. It had been initially pushed by Elizabeth Warren. The president backed it as well. They seemed to agree on something for what had to be the first time ever. And we criticized it pretty heavily. Here is my take on that type of ban is it really disincentivizes single-family home construction. And a lot of it today is done by institutional investors who want to rent out the properties. In my mind, positive news, in other people's mind, I'm sure bad news here, is the House just passed a bill, they're voting on a major bill as soon as today, called the 21st Century Road to Housing Act. On the good news side, it does reduce builder regulations, makes it easier to develop factory-built homes. Again, my opinion there would be anything you can do to reduce regulations that are unnecessary on construction is a step in the right direction. I'm not saying they will be extremely high-quality houses. I'm just saying that they will probably
More
be
supply.
cheaper.
That's all you want.
And it does remove one of the key pieces of that institutional investor one. So in the Senate passed bill, there was a rule where if an institutional investor built new homes for rent, it would have required those investors to divest of the homes within 7 years. The House version strips that out.
Yep.
So it still bars institutional investors from buying single-family homes for rent, but it does not prohibit them from constructing them. So basically, if you want to go build a 1,000-unit development and rent them all out, you can do so without any restriction that you sell them eventually. This only bars you from going and buying up a bunch of those homes to rent them. I don't really like that either, but the big thing that we've been focusing on is how do you incentivize more construction? And this at least does not remove an incentive there. If you want to build the homes and rent them, you are allowed to do so under this House proposed bill. You just can't go and buy a bunch of them. So what do I think that does? I think in a moment of crisis, it might make housing prices fall more. So I think we might regret this if we go face another 08 20 years from now.
Exactly, because they make the point that in 2008 that institutional investors scooped up a bunch of properties on pennies on a dollar. Yes, in retrospect, we look at it that way, but it was liquidity that was created in the system that was able to snatch up those properties then, and that's the whole investing world in general, right? With buyers and sellers, you're constantly trying to match the two, and it's important to have liquidity in the system when things get tough. And to your point of now these existing single-family homes that would be sold, you have one less buyer in the market. It was an area where I wasn't overly concerned about the impact. If you look, it's 2 to 3%, I believe, of single-family homes are owned by corporations. When you brought it out to the housing in the country in general, it's higher because there's obviously those multifamily properties that are corporately owned. I just don't know if this was as big of a problem on my end. Granted, we live in an area where there's not a lot of it, but
I don't think it's going to have much of an impact at all.
Yeah.
Again, I think the right thing to do, it's small work around the edges to reduce some of the regulations, but is it going to suddenly or even over the next 5 years make housing more dramatically affordable? No, because that really needs to be done on the local level.
Yeah.
There's really very little, unless you're going to come out with a massive carrot and stick to incentivize municipalities to change, that can be done to make housing more affordable other than the local stuff. Which, we're seeing here in Massachusetts currently. It ain't working terribly well. I forgot about a new law in Massachusetts. There was a law passed August of last year, I believe it was. Yeah, August of last year, that banned brokers in the state from receiving broker's fees directly from tenants. So this is common practice. I paid one for my first apartment in Somerville. Pay 1 month's rent to the broker as a giant fee. That was banned on August 1st, and apparently nobody cares.
They're still collecting it. Yeah, I spoke with someone over the weekend who rented a place effective July 1st in Boston, and she had to pay half the month's fee, which was down from what she previously did, which was the full month, but she still had to pay the half one. And then she found that the service was even worse, where she just was not getting any help from the realtor at all. And she tried to call the listing directly. They wouldn't pick up her calls unless it was a realtor. So it seems like everybody is kind of in cahoots to lock that fee down.
According to mass.gov, you can apparently be entitled to triple the amount of any illegal fees paid. So might be worth inquiring about that. We got to take a quick break, but a lot more to cover in the second hour of the Financial Exchange. We'll be right back. Stay tuned.
Cardiovascular disease is the #1 killer of women,
taking the lives of 1 in 3.
That's more than all forms of cancer combined.
For too long, heart disease and stroke have taken the lives of the women we love.
But we're not giving up.
Because we have something better.
Stronger, more powerful.
We have each other.
When we come together and go red,
the more power we have against our greatest health threat.
Visit GoRedForWomen.org today to learn more.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke with your Financial Exchange Quick Tip of the Day. And today we're talking about the top estate planning mistakes to avoid. Todd, what is the downside of adding your kids to your accounts or adding their names to your real estate deeds as a joint owner? Won't this avoid probate?
You're absolutely right. It would avoid probate, but there are better ways to avoid probate than just doing something simple, right? It's not, simple isn't always better. Throwing a name on an account or adding a designated beneficiary or a joint owner on a piece of property might not be the best way to go. Here's the problem. If you name one of your children as a joint owner and you have 3 children and you put that child on just because it's convenient and they're geographically close to you, well, you could be accidentally disinheriting your other children because this property, this asset will only go to that child. That child doesn't have to give it to the other kids. So that's a problem. And if you put your name, if you add a child's name to your real estate, now you're exposing it to that child's creditors, that child's potential divorces. That's never good. And plus, you've lost control over it. If you try to sell it, you need that kid's permission, and half the money would go to that kid. Please, folks, set up a trust, fund your trust much better than just trying to do it shorthanded and just give away assets or adding names to accounts.
Todd Lutzke and the estate planning experts at Cushing & Dolan have written a brand new guide that details the estate planning blunders to avoid. You can request this brand new guide by calling 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM. Concord, Boston, the Money Matters Radio Network.
For many hardworking families and retirees, an energy bill comes with an impossible choice. Paying the bills, putting food on your table, and keeping your family warm in winter and your home cool for the summer. But it shouldn't be that way. For more than 40 years, Citizens Energy has made one simple promise: to help households afford life's basic needs. Through Joe for Oil, we help neighbors through the coldest winter nights. Now, we're building on that same promise with Joe for Sun, a new way to save on electricity year-round. Our solar projects are already in communities across Massachusetts and New York, helping thousands of households save money. For many families, that means saving up to 50% on electricity. No installation, no equipment, and you keep your utility company. Like my dad's program before, we keep it simple, helping lower your utility bill through community solar at no cost to you. Call 1-855-JOE-FOR-SUN or visit citizensenergy.com to see if you qualify. You've trusted Citizens Energy to show up when it matters most. We're still here, ready to help. Sponsored by Citizens Energy.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Our Senators Edward Markey and Elizabeth Warren and Representative James McGovern are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we have a guide this month titled Consolidating Investment Accounts. Mike, what are some of the problems that people run into when they have accounts scattered everywhere?
The first one is just difficult to maintain and monitor. I can't tell you how many times I've met with somebody who has a life insurance policy that still has their brother on it instead of their wife or their husband, for example. So it does become really tough to monitor those things. If you're getting to required minimum distribution age, there can be certain rules around where you take money out of specific accounts, and if you miss it, there can be tax penalties. So it just becomes complicated to administer everything.
Despite that, there are still some cases where it makes sense to maintain a number of separate accounts as opposed to consolidating.
Oh, absolutely. I mean, we all know cases where, hey, that new bank is going to give you a better CD rate or introductory rate, and that can be worth real money. In other cases, you know, if you have a retirement plan, there can be special benefits to keeping the money there. Maybe it is a excellent plan with really low costs. Maybe it'll allow you to avoid a required minimum distribution if you're still working into your 70s. Or there can be other strategies too, you know, having money in a retirement plan and allowing you to do what's called a backdoor Roth conversion, all sorts of things that allow you to take advantage of having accounts in specific places.
Folks, the guide is titled Consolidating Investment Accounts, and there are two ways to request it. The first is by calling 800-393-4001. The second, by going to armstrongadvisory.com. That number again is 800-393-4001, or request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Good morning. Welcome back to the Financial Exchange. It's Mike, Paul, and Tucker with you on a bit of a sell-off Tuesday here. Interesting to me, too, by the way, that overnight, obviously, the president announced we were delaying any new strikes on Iran, and nonetheless, not enough to move markets today. Oil prices falling a little bit in early trading, but stocks off a pretty substantial amount here. We got the S&P 500 off 0.75% in early trading. NASDAQ a little bit more. Oil prices, West Texas crude edging lower, but not by much. 0.5% down to $108 a barrel. On the bond side, the 30-year Treasury yield has jumped to 5.18%. That's the highest. Wow, is that the highest since pre-08? Hold on a minute.
The 30-year has hit a 19-year high, but you're looking at the
highest
10-year?
level since July 2007 on the 30-year Treasury. So nobody likes comparisons to pre-Great Recession. On the 10-year side, we're sitting at just shy of 7% on that 10-year Treasury yield. Mortgage News Daily has the 30-year fixed-rate mortgage sitting just shy of 6.7%. And taking a look at gas prices here according to AAA, still pretty steady here. $4.53 per gallon on the average, according to AAA. We've talked at length about the pending, supply miss here, and the likely outcome for prices domestically and across the rest of the world here later this summer should things not reopen. I suppose you can call today at least not reversal on progress, but I don't see much progress as we sit here now. 10, 11 weeks into the war in Iran? Something along those lines.
Week 11, right?
Coming up.
Yeah.
Coming up on 12.
Big event coming up later this summer, it seems. SpaceX intending to IPO. Some estimates run it near the $2 trillion mark. Another one of Elon Musk's companies, which has now been already combined with XAI and SpaceX. I believe that means also that Twitter will be folded into this IPO, which is very interesting. You go and buy one company that runs what was once one of the most popular social media sites, combined with a rocket company, is not exactly what you think of, other than when you think of Elon Musk. Look, I think this will be probably the most well-known IPO that we have seen in...
I was going to say since Facebook, probably.
Yeah.
Can you think, Uber and Airbnb are popular names as well, but not to the extent that Facebook, I feel like, really took hold.
Yeah, it's obviously very different. Uber, Lyft, Facebook, all were consumer-facing products. SpaceX is only public-facing because we've all seen their rocket launches on TV. But nonetheless, now one of the largest defense contractors in the world, and arguably the most advanced in terms of space exploration right now. It's also one in a long list of companies that have chosen to stay private for an incredibly long period of time.
25 years since its founding.
And you do just one that speaks to the operation of markets today compared to the 90s. And we've talked about this a lot before, how there's just many fewer publicly traded companies today than there were back then. That has to do with market mechanics, how much compliance costs there are to being public, and how much access there is to cash while in private markets compared to 30 years ago. But furthermore, it does obviously raise the question of, when you're talking about a company as mature as SpaceX going public, how much of the easy money has already been made? And there's no way to know that, but tough for me to... We made this comparison yesterday. I think Tesla went public in, what was it, Tucker, 05 or something like that?
2010.
2010, and increased in market cap by, I think, 100 times. Very difficult to envision a scenario where a $2 trillion company does something like that.
Right.
So obviously going to be a massive IPO, the fanfare of which will be unlike anything we've probably seen, to your point, since Facebook, which was a very messy IPO. People kind of forget about that, but Facebook's IPO was a bit of a disaster. There were no trades. Nobody knew what price they were paying for the stock on the public market until like the next day, if your order had even been filled. I suspect it will go off a little bit more seamlessly than that, but there are a bunch of desires that Elon Musk has here, including offering shares to loyal customers of his other brands and things like that, so that I don't know how will be worked out. And so, interesting piece of all of this.
It's going to be fascinating to follow. They're trying to aim to raise about $75 billion through the IPO, and
which, by the way, we haven't even talked about that. That small of a portion available on public markets would normally disqualify a company for even consideration in major indices.
Yeah, and I think what's going to be important for investors to be aware of is that you have a lot of other investors on the private side, hedge funds and venture capital firms, that are going to have to navigate the lockup period that's associated with these IPOs, where there's a certain amount of days. I don't know SpaceX exactly, where other companies out there hypothetically have 90 days where you're locked up. The company goes public before you can sell your shares if you've been an inside holder. And so that liquidity aspect is always a consideration when you go into IPOs. There's just a lot of fascinating angles to this. The interest is going to be really through the roof, and the valuation seems like it's going to reach that level too of potentially, $1.5 trillion. It's going to be a pretty significant event.
Massive. So what's the date again that they're targeting?
June 12th is what they are targeting to list on the NASDAQ at SPCX would be the ticker. That's what they're targeting. Again, these things can move around.
They can. Can we take a break, Tucker? Is that all right by you?
Let me check.
Yep. All right, let's take a quick break. When we come back, playing a little bit of trivia next, and then I want to talk about the concern about correction risk and just general concern that investors seem to have today given everything going on. That's next on the Financial Exchange.
Market insight, retirement strategies, real talk about Wall Street and economic trends. All live every day on our YouTube channel. Go to youtube.com/The Financial Exchange Show. This is The Financial Exchange.
Hi, this is Chuck from the Armstrong Advisory Group. If your financial life feels scattered, you're not alone. Over time, it's easy to end up with accounts in different places. Old retirement plans, different banks, multiple apps. It's what we call account sprawl. When you've got your money across the spectrum, things can get missed, like overlapping investments, and bringing everything into focus allows you to spend less time tracking accounts and more time making smart decisions. Our new guide is called Consolidating Investment Accounts, and it may offer strategies that can simplify your overall financial picture. Call 800-393-4001 to get your free copy today. That's 800-393-4001, or you can request the guide at armstrongadvisory.com. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. It's important to update your estate plan as changes occur in your life, or you can wind up with significant issues that may affect your future. Get Cushing & Dolan's new guide called Detour Ahead, Estate Planning Potholes to Avoid. Call 866-848-5699 and get your copy today, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes, and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Our Senators Edward Markey and Elizabeth Warren and Representative Jake Auchincloss are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, the grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
In a heartbeat, you could be the difference.
Mark collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. Heart Walk brings communities together to create health and hope for every heartbeat. Every walker who joins Heart Walk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local Heart Walk. Extraordinary starts with you. Join Heart Walk today. Find your local Heart Walk at heartwalk.org.
Markets move fast. Follow the Financial Exchange live on X so you never miss a story. This is the Financial Exchange Radio Network.
All right, time for trivia here on the Financial Exchange. And on this day in 1643, Massachusetts Bay, Plymouth, Connecticut, and New Haven formed the United Colonies of New England. The New England we all know today didn't come into its current form until 1820. So our trivia question today, which was the final state to join the region of New England? Once again, which was the final state to join the region of New England? Be the sixth person to text us at 617-362-1385 with the correct answer, along with the keyword trivia, and you'll win a Financial Exchange Show t-shirt. Once again, the sixth correct response to text us to the number 617-362-1385 with the correct answer, along with the keyword trivia, will win that t-shirt. See complete contest rules at financialexchangeshow.com.
Paul, we've been experiencing a phenomenon in markets that is somewhat rare. Since late February, the 10-year Treasury yield has increased from about 4% to nearly 4 2/3%. That is a massive uptick. And we've experienced that several times in the last decade where an increase in yields sinks stock prices, and they tend to move inversely. What we've experienced here, we did see a temporary drop in stock prices, as we all remember, back during the initial stage of the war. But now we've seen stocks since late February recover all of their losses and increase pretty dramatically. We've been on a substantial run up. And some are warning about the divergence of this. Hey, as the cost to borrow money goes up, it naturally makes stocks look less attractive. And there's some basic mechanics here. The first basic piece would be when you're valuing a company, when you're talking about SpaceX, and you're trying to look at, hey, this company could be worth X number of $1 trillion. If you're actually trying to put a value on it, what you're doing is you're saying, okay, I believe that the cash flows of this company in the future are going to be this much higher, and therefore, if I assume that and I discount it back to today's value, then I can justify paying XYZ price for this company or that company. And the higher the interest rate, the higher the discount. Mm-hmm. And because alternatively, you could always go put the money in a treasury bond for 30 years, paying 5+%. To put this more simply to the average retail investor, you've got cash. I can either go buy a CD paying me now, let's call it 4%, or I can go put it in stocks. Which one is going to pay off better for me? Or I could go buy a piece of real estate or take your risk asset of choice. When interest rates are higher, it makes everything else look a little bit less attractive. That has broken down over the last few months. Mm-hmm. And it has to do with the fact that the economy is, and companies in particular, are just ripping growth right now. Whether you look at GDP, which came in at a pretty respectable 2% for the first quarter, 80% of which has been attributed to AI and the growth of it that's going there. Or, I think more importantly to the stock market, take a look at earnings growth, which came in for the first quarter so far in the high 20% year-over-year level. It's that combination of things that seems to be convincing investors to not worry about rates.
Yeah, it's these two different paradigms that you're sort of focusing on at the moment. One is that 28% year-over-year earnings growth for the S&P 500 as reported by FactSet, we've got 91% of companies that have reported this quarter. So most of them are in the door. That's a tremendous amount of earnings growth year over year. The last time we were above that number was about 5 years ago in Q4 of 2021, and that was ripping right off of the pandemic Q4 of 2021. So that's one aspect of things. You can make the argument as a bullish investor, gee, companies are earning a lot more money. There was a concern heading into this year that stocks were overpriced relative to where they've traded historically. Some of those concerns have been assuaged by the fact that, great, we have seen growth in earnings, so that has brought down that price multiple mix that we've seen a little bit, still at an elevated pace in general from a historical perspective. The other argument you can make is the inflationary one, where you have the Strait of Hormuz that has been closed for 11 or 12 weeks now, and 1/5 of global trade has been halted and is no longer going through that passageway. So there's a tremendous amount of inflationary pressure, and that's put pressure on interest rates. If you're bullish, you're willing to overlook those inflationary concerns, and it feels like the market has over the last month or so. I would say it seems like more so this week there's been a little bit more focus perhaps on that inflationary risk that looms out there. That's kind of the state of where markets are right now, these two tracks, and you have to ascribe, more faith in one or another, sort of conveying this inflationary pressure in a market setback, or we continue to rip along.
In the summer of 2022, I was out in Utah for a gorgeous wedding in Park City, which was a lot of fun, place I'd never been before. And I was taking a cab to the hotel, and it might have been an Uber, I don't actually recall. But in either case, my driver was just peppering me with all sorts of cryptocurrency picks at the time. He was, a big winner on the crypto trade and was really pushing his book, to which I said, okay, wow, we might have hit
probably
some
time to
problems
sell
here for cryptocurrency. Maybe I just haven't been in enough cabs recently or been speaking with my Uber drivers as much as I usually do. But I haven't heard the same thing coming from the general retail investor boasting about their semiconductor picks this year that have, clearly in a lot of cases gone through the roof. But there is this piece today in Bloomberg about the AI boom being a dilemma for retail investors. And the dilemma is plain and simple. On average, retail investors have made a lot of money on the AI trade. And on average, retail investors have a pretty notorious reputation of being bad at diversifying and selling their gains when they have realized them. And that's what it's really setting up. And have no real way of measuring if what we're in right now is a bubble that is going to pop anytime in the near future. But I do continue to see a lot of comparisons back to the .com. The .com one is the one that I keep latching on to because there are just more and more of these very exciting IPOs that launch and increase 300%, and people who are quitting their job to be day traders. Maybe more of them are trying to quit their job to be polymarket bettors. I'm not really sure. But in either case, when we see such a concentrated market move like the one that we've seen recently, it does set things up for some potential damage to things down the road based on, at least historically, how booms like this have ultimately ended.
Yeah, we've talked about the private credit issue as something that we are concerned about heading into this year. And the argument we've always had there is that doesn't have the same sort of ripple impacts of people being exposed to that type of
at least
retail investors.
Yeah.
And where I'm going with this is with the tech sector and AI, that is the opposite, where you have the tech sector, the weighting in the S&P 500, which many retail investors hold or hold something like it in their 401ks. That's about 30% the weighting. If we have some of these bigger IPOs coming this year that have been rumored, OpenAI and Anthropic, you would imagine that they eventually sort of find themselves into that sector too, and all of a sudden...
Where are we headed? Like half of the S&P 500 being tech?
You start trending up into these really high concentration percentages, and couple that with the fact that a lot of these big hyperscaler players are using these circular financing methods where NVIDIA is investing in OpenAI in return for OpenAI spending billions of dollars to buy their chips and servers. If one cog in that wheel breaks, you have this, dramatic impact. And I don't mean to say that as some doomsday for listeners out there. I think there could be momentum that continues for this for a while. Who knows? I don't know when the buck stops, but you're right. There's elements that are reminiscent of that late 90s period that all of us in this economy game tend to bring up, it feels like.
We've talked about this before, but the markets right now, to me, are facing three major threats. One of them is the innovation of a new exciting technology that is drawing in the exact type of investment that we have seen from almost every major technology in history, whether it's the automobile, trains, radio, or the internet. Mm-hmm. It very much looks like those events in terms of the investment that it's drawing in and the race to build out the infrastructure to support it. Go look at the stock market history on those. Most of them did not end terribly well. We face a debt mess from private credit that is smaller than, but reminiscent of the mortgage-backed security crisis of 2007. And on top of that, we're facing an inflation shock and rising interest rates due to an oil price shock. I do believe that markets may be able to navigate any one of those things. My fear would be that a lot has to go perfectly right for markets to successfully navigate all through three of those potential risks that at any point in time could be worse than we perceive.
That's fair.
That's all.
But if you go back to the 90s, you can say, oh, yeah, it crashed and burned and the dot-com bubble exploded. But step back, and 5 or 10 years after that, the same argument, I don't know, could necessarily – there was a lot of coffins of companies that went down and went under, but there were a lot of companies that came through and have tremendously benefited from all the investment during that period of time.
True, but how long did it take you to make your money back if you were all in the NASDAQ in 2000?
That's why you don't over-concentrate. But yeah, it
close
took a
to
while.
20 years? It was a while. Yeah. So that is the fear that concerns me is you had a lost decade in the 2000s.
Right.
You lost a bunch of money, made it all back by 2007, and then lost it all again.
Right.
Quick break. Wall Street Watch coming up next.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative Stephen Lynch are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
In Massachusetts, summer starts at the farmer's market. Longer days, fuller tables, and the best local food coming in fresh each week. Find just packed produce, responsibly raised meats, small batch cheeses, fresh caught seafood, and thoughtfully made goods. It's where neighborhoods come together and local food shines. Stop by your market this season and support farmers and makers across the state. Sponsored by Mass Farmers Markets. Growing farmers markets across Massachusetts. Find your local market at massfarmersmarkets.org.
Long-term care costs can reach thousands of dollars per month and can put a serious strain on your savings. The experts at Cushing & Dolan often see families caught off guard by that reality. Without the right plan in place, those costs can quickly eat through a lifetime of your hard work. But here's the shocker. Many estate plans don't protect your assets from those expenses. The right strategy may involve specific types of trusts designed to help protect your assets, but timing matters. Cushing & Dolan has a brand new guide called Detour Ahead, Estate Planning Potholes to Avoid. It breaks down some of the most common and costly mistakes people make and explains how to help protect your assets, your family, and your future. Call 866-848-5699 to get your free copy today. That's 866-848-5699. Or you can request the guide online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
For many hardworking families and retirees, an energy bill comes with an impossible choice. Paying the bills, putting food on your table, and keeping your family warm in winter and your home cool for the summer. But it shouldn't be that way. For more than 40 years, Citizens Energy has made one simple promise: to help households afford life's basic needs. Through Joe for Oil, we help neighbors through the coldest winter nights Now, we're building on that same promise with Joe for Sun, a new way to save on electricity year-round. Our solar projects are already in communities across Massachusetts and New York, helping thousands of households save money. For many families, that means saving up to 50% on electricity. No installation, no equipment, and you keep your utility company. Like my dad's program before, we keep it simple, helping lower your utility bill through community solar at no cost to you. Call 1-855-JOE-FOR-SUN or visit citizensenergy.com to see if you qualify. You've trusted Citizens Energy to show up when it matters most. We're still here, ready to help.
Sponsored by Citizens Energy.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke with your Financial Exchange Quick Tip of the Day. And today we're talking about the top estate planning mistakes to avoid. Todd, what is the downside of adding your kids to your accounts or adding their names to your real estate deeds as a joint owner? Won't this avoid probate?
You're absolutely right. It would avoid probate, but there are better ways to avoid probate than just doing something simple, right? Simple isn't always better. Throwing a name on an account or adding a designated beneficiary or a joint owner on a piece of property might not be the best way to go. Here's the problem. If you name one of your children as a joint owner and you have 3 children and you put that child on just because it's convenient and they're geographically close to you, well, you could be accidentally disinheriting your other children because this property, this asset will only go to that child. That child doesn't have to give it to the other kids. So that's a problem. And if you put your name, if you add a child's name to your real estate, now you're exposing it to that child's creditors, that child's potential divorces. That's never good. And plus, you've lost control over it. If you try to sell it, you need that kid's permission, and half the money would go to that kid. Please, folks, set up a trust, fund your trust much better than just trying to do it shorthanded and just give away assets or adding names to accounts.
Todd Lutzke and the estate planning experts at Cushing & Dolan have written a brand new guide that details the estate planning blunders to avoid. You can request this brand new guide by calling 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Markets are selling off as investors digest first big retailer earnings from Home Depot this morning. As for the Middle East, President Trump announced late yesterday he was calling off a plan to attack Iran after Gulf states appealed, wanting more time to pursue diplomacy. Right now, the Dow is down nearly 0.5%, S&P 500 down 0.75%, NASDAQ selling off over 1% or 292 points lower. Russell 2000 is down 1.33%. 10-year Treasury yield is up 5 basis points at 4.67%, and oil down about 0.5%, trading right around $108 a barrel. Home Depot up modestly after the home improvement retailer beat expectations on the top and bottom lines and reaffirmed its full-year guidance. The company also said its core consumer remains engaged despite higher gas prices and waning consumer confidence. Lowe's, TJX, and Target will report their earnings tomorrow morning ahead of the opening bell. Meanwhile, the Wall Street Journal reported that Alphabet's Google and Blackstone plan to create an AI cloud company to compete with the likes of CoreWeave using Google's specialized chips. Alphabet shares down by 2%, Blackstone down nearly 1%, and CoreWeave shares are down over 7%. And Cisco is now down by 3% after its CFO warned that the company would see ups and downs with its gross profit margin as it pushes further into AI infrastructure. I'm Tucker Silva, and that is Wall Street Watch. On the previous segment, we asked you the trivia question, which was the final state to join the region of New England. That would be Maine. And Adam from Orleans, Mass. is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Adam. And we play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Market Watch has a piece today about inflation and retirees and an interview with a financial advisor who describes a phenomena that he's experienced before that I think Paul and I have both experienced before too, which is occasionally somebody will have a big expense. They'll need to take money from a portfolio that bumps them into a higher income tax bracket. That tax then needs to get paid in the next year, meaning more money needs to come out of the portfolio, and it becomes problematic. And he makes the point that, hey, retirees with inflation face that triple threat because of that high inflation, which I would debate. One, retirees do face inflation, just like the rest of us. Mm-hmm. And they just got a massive tax cut so long as they don't make more than $150,000 as a household. Furthermore, the tax brackets themselves are indexed to inflation. And recently, that inflation for the average person has been higher on average than what retirees face. Gasoline prices. Do you drive more when you're retired or less? Most people drive a little bit less. Medical care services has been printing inflation that's lower than overall inflation. So generally speaking, I don't really buy into the idea that retirees, when they're faced with inflation, are going to have this, self-fulfilling destruction of their portfolio because they need to take out more and more. Yeah, they might need to take out more and more, but the tax brackets are growing with them, and this new massive deduction that they're getting on for being over the age of 65 makes it so that this is not much of an issue. But I do want to talk about that one phenomenon where, hey, a lot of retirees do find themselves in a place where anything that they touch from their savings in order to pay for bills generates a tax bill, and how you navigate that once you're in that retirement stage, Paul, because it's definitely something you and I have run across and tried to come up with creative solutions for how to fix that problem.
Yeah, what happens often, Mike, is you enroll in your company's 401k plan when you start working, and pre-tax contributions are the prevalent way that people contribute to their retirement savings, but as you and I know, and many retirees listening know, that when you go to access the funds that you've built this pre-tax nest egg on, whether it's in a 401k or IRA, you got to pay taxes on everything that you take out. And so you spend years, 30, 40 years working and saving to build that nest egg. But then when you go to take out 10 grand, to get that net 10 grand, you have to typically take out more and gross it up to account for the taxes associated with that. So a lot of our planning goes into that to try and how do you build a three-legged stool approach to have a blend of some pre-tax dollars, some Roth dollars, and some regular dollars so that you can control your taxation a little bit better in retirement. That's what we try and work towards.
And one issue that people sometimes are not aware of, so is worth knowing. When you're working, you get hit with that $40,000 surprise expense because your car gets totaled, if something goes wrong in the house. You have the option to at least borrow from the 401k. It's oftentimes not a good idea, but you can borrow from that. There is no mechanism to do that once you're retired.
Right.
Yeah, like the loans don't get made.
You can't
you can't borrow from an IRA, so there is no mechanism for that loan to be facilitated in retirement. And so, frequently, I'm sure, Paul, you've been faced with this too. It's, hey, we have this big house project. We need to do it. All we have are IRA assets. What do we do? And that's where the planning does come in to actually evaluate, like, okay, so we could pull out $100,000 for you to make renovations to your home. That's what it's going to do to you in taxes and Medicare premiums 2 years from now. Or do you take out a home equity line of credit and pay that thing off over 2 years in order to spread out the taxation?
Right.
Or if you do have more of that three-legged stool approach, hey, am I better off taking from the Roth here? Maybe I've got some appreciated stock that I could sell and face capital gains. In that case, where I have appreciated stock, I might be able to borrow off of that. So, how do I shape all of this in order to, again, none of this has to do with buying the right investment and growing your portfolio that way. All of this that we're talking about purely goes into, hey, how do I increase my return by paying less in taxes? And that is a really key focus of any financial planner that's out there working with a customer on planning out their expenses and ensuring that I know everybody worries about the tax bomb of having a big IRA and the required minimum distributions that are going to come, but it's more than just that, because yes, the IRS is going to eventually force you to take out money, but what if something happens and you need money?
Mm-hmm.
How do I go about facing that emergency cost when all of my money is 401k?
Right.
And those are these issues that advisors try to address. If you have questions like that, if you're unsure of how your plan is going to work with your mix of retirement assets, folks at Armstrong would love to talk to you about how to maximize your portfolio, not only from an investment, but also from a tax planning perspective. The number for the advisors at Armstrong, 800-393-4001. Offices scattered throughout New England. Happy to meet you close to where you live. Again, 800-393-4001 or armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
A few pieces of breaking news in the AI universe. One, in the Musk versus Altman trial, the case got thrown out. It was Elon Musk suing OpenAI over actions by the CEO Altman. The jury threw out the case based on the statute of limitations, but a lot of discovery happened there, including a bunch of conflicts of interest of members of the boards of OpenAI and the investments that they had made in their personal accounts, and then the conflicting investments that they made on behalf of the business. And then separately, one of the founders of OpenAI has reportedly joined Anthropic now, which again is interesting in and of itself that has taken place now.
Yeah, Andreas Karpathy is his name, and he's sort of the one of the foremost experts on AI in terms of the sort of experience that he has. He was one of the founders, like you mentioned, of OpenAI back in 2015. He and another colleague at Stanford created the first sort of deep learning artificial intelligence course going on 11 years ago. And so he is someone that has garnered tremendous amount of respect in the space. Switching sides there to Anthropic sort of is another hit that OpenAI takes, and I was joking with Tucker off air that if OpenAI was a public company, this would be something that would take their stock down more in terms of negative news. They had another Wall Street Journal piece where they had missed some internal revenue targets. It seems like they're facing a little bit more pressure as they were the darling back in November of 22 that ChatGPT was released. They've struggled since.
You'll appreciate one of these responses on the post from Andrej on X. Somebody says this is like Kevin Durant joining the 73-9 Warriors.
Yeah. Well done.
That's pretty
well
solid.
done.
I don't even like basketball,
even Mike can pick up on that. Yeah.
The piece of all this that I really struggle to wrap my head around, maybe this is the wrong comparison to be making, but I don't understand if these models are going to go the way of search, where initially in the days of the internet, there were a lot of different search engines that were all competing, and one of them came to dominate.
Mm-hmm.
To the point now where we don't say we're going to online search something, we just say we're going to
DuckDuckGo.
Social media didn't go that way, right? Like social media started off with MySpace, then Facebook took over. Soon thereafter, Instagram was getting hot, so Facebook bought them. Snapchat and others are still, coming about. TikTok and kind of usurping where the eyeballs go.
Yep.
And I really have a very difficult time. I mean, from my perspective, AI tools seem a lot more like search than they do social media, from the mere perspective of, if I'm using Gemini every day, nobody other than all the advertisers and Google themselves know that I'm using Gemini instead of ChatGPT. You don't know. My social network doesn't know unless we talk about it. But on the other hand, clearly these tools are leapfrogging each other in terms of capabilities, and the power users are definitely wanting to put themselves in a position where they can readily switch from one to the other. And so I just have a really tough time understanding if it is going to be a winner-take-all, or if it's going to be just this constant game of switching and competing, in which case maybe the models don't really have any moat. I don't know.
The model argument has been made that it's the fastest appreciating asset out there. There's a tremendous amount of input costs that go into training your models, and that now that you have 3 or 4 options out there, that they could be, eroded down in terms of value. That's thinking of it from the consumer prism of like Mike and Paul, how do we use it as individuals? On the enterprise side, the reason that Anthropic has become, it seems like more of they were just named, number 1 disruptor in the CNBC list that they point out every single year, where they point out the 50 most disruptive companies, where I'm sure OpenAI, I'd have to look back, the list was probably at a higher point than Anthropic was before. And that's because Anthropic has really established a lot of dominance in the enterprise market, where they've seen their revenue growth just absolutely explode. I believe they're running at an annualized revenue rate of $35 billion a year, and that number was, call it a couple billion just a year or so ago. I mean, the company was only founded within the last, 2 or 3 years. So it's just explosive growth that you're seeing on the enterprise side. I feel like that is maybe the area that deserves more focus than the consumer lens for the moment.
Yeah, and yet I will say, when I speak to the general public about their user habits, like, I think still most people are using GPT if they have an app on their phone and they're just using it for casual stuff.
Yes, I feel like that is more the case.
So it'll be fascinating to see which way these develop. In a best case scenario for the consumer, they get monetized and just become better and cheaper, like a lot of these different platforms. I don't know what that means for the stock market if that happens. So let's take a quick break. When we come back, a little bit of stack roulette here on the Financial Exchange.
From markets to money to business and financial news, watch the Financial Exchange every day on YouTube. Hit that subscribe button and keep up to date on the market news you need to know. This is the Financial Exchange. It's important to update your estate plan as changes occur in your life, or you can wind up with significant issues that may affect your future. Get Cushing & Dolan's new guide called Detour Ahead, Estate Planning Potholes to Avoid. Call 866-848-5699 and get your copy today, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes, and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One of the biggest challenges in financial planning is seeing the full picture. When your investments are spread across multiple accounts, it can be difficult to know how much you actually have and whether your strategy is really working. You might be taking on more risk than you realize, or missing opportunities to better align your portfolio. Bringing your accounts together can help create clarity so you can see your total assets, your true allocation, and make more informed decisions about your financial future. Our new guide is called Consolidating Investment Accounts. It walks you through how to get organized, simplify your strategy, and build a more complete financial plan. Call 800-393-4001 to get your free copy today. That's 800-393-4001, or you can request the guide by visiting armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
For many families, an energy bill can mean difficult choices, wondering when or even how it will get paid. It shouldn't be that way. For more than 40 years, Citizens Energy has helped families afford life's basic needs. First through Joe for Oil, and now through Joe for Sun. A simple way to save on electricity at no cost to you. No installation, no equipment, and you keep your utility company. We keep it simple and help you lower your utility bill. Call 1-855-JOE-FOR-SUN or visit citizensenergy.com to see if you qualify.
Sponsored by Citizens Energy.
It happens all over Massachusetts. In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
Text us at 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we are covering. This is the Financial Exchange Radio Network.
Stack roulette time. Paul, what do you have for us this morning?
Mike, I thought the travel agent job was dead long ago with the advent of the internet and online travel agencies. And then
there's a giant building right across the highway called TripAdvisor that, attempted to just do that, put it out of business.
Exactly. Stunning to me, a piece in the Wall Street Journal here that the travel agent profession is growing, with the industry revenue now projected to reach $134 billion this year. That's up 17% from where it was in 2023. And there's even posts on LinkedIn that indicate that it is one of the 25 fastest growing jobs over the course of the last 3 years, the travel advisor. And it stuns me just because I feel as if that many people that I talk to, whether my parents or clients, seem to be able to roll up their sleeves and sort of plan out travel itineraries themselves with all the tools that you have available online to search things, to sort out reviews. But it seems like on the higher end of things, there still is a tremendous amount of emphasis for people to try and find out special nooks and, experiences that they can sort of partake in by contracting out a travel advisor, a trip advisor, to do that.
So here's what I'm comfortable saying. So my family just went down to Disney World, which I'm hoping to not do again in my lifetime, but not because it was a terrible experience. It was not a terrible experience. It was just a lot, and it's not my idea of a relaxing vacation. But we did utilize an agent there, and Disney compensates them, and they don't offer you a discount if you don't use one. And frankly, there is not a lot that I've done that is more complicated than navigating the complexities of park passes and understanding the terminology at Disney World. I can kind of comprehend why, if you are spending as much money as you need to spend now to travel on one of these Instagram-worthy vacations that people are trying to take, why you might say, yeah, I'll spend 5% of that on a travel agent so that I don't screw something up and land me with a bunch of missed flights or lost baggage or the risks that you run of running into a tourist trap that you weren't aware of. Because you trusted AI to plan out your trip. So I guess I can get it in that context of, hey, I'm about to spend $10,000 on a trip to Italy as a retired couple. Yeah, I'm sure I could do the research, but I'd rather trust it to somebody who knows what the heck they're talking about. I can comprehend that.
That's
when
fair.
You're talking about such a big purchase.
I guess I'm thinking from the lens of, when you do a beach vacation, there's not a lot of strategy. It's just like, hey, what beach you're going to plop your chair on? But the complexity that would come with an Italian vacation is a far different deal in terms of what cities do you hit, what tourist locations do you hit, what museums, what sites do you see, how to string that all together.
For me personally, I have no interest, only because like half of the fun of going on vacation to me is, dreaming about it and planning it and like doing the work of figuring out what we're going to do. Example here, we traveled, my wife and I, recently, and I did use AI to try and build out some of the plans. and we were doing this big hike, multi-day hike with a hut that we were staying in, it completely screwed up.
Really?
It basically told me that this trail existed that I could get from point A to point B that did not exist, and there was no actual way of doing so. And had I followed the instructions, would have been in some pretty bad places. But again, even that I enjoy being like, oh, well, the AI has no actual idea what it's talking about. I instead need to go to this other website and figure it out. But yeah, if you're spending thousands of dollars on a vacation, which for a lot of people is what they are looking to do these days. Yeah, it sometimes can pay to have that professional that actually knows what they're doing. It's all the time we have for today. Markets are continuing the sell-off, but not worsening. NASDAQ off 1.25%, S&P off 0.75%, Dow closing in down 0.5%. We'll be back at it tomorrow. Tomorrow after the bell, NVIDIA reports earnings, so tune in for the rest of the week. Big earnings week here as we close out Q1 earnings season.